Good morning or good afternoon, everybody. Thank you very much for joining us here at LiveVox for our In Live series, talking about everything happening in financial services. Today, we're lucky enough to be joined by Kevin Moss, an industry leader, really a chief risk officer guru, and a man of many talents. And so this podcast, of course, is sponsored by LiveVox, the leading platform in contact center solutions. So with that, let's dive right in. Kevin, thank you very much for joining us today on this podcast.
Thanks for having me, Boris. Appreciate the opportunity.
Yeah, absolutely. Kevin, you and I have a long history and we go way back, but maybe a lot of folks aren't familiar with you, with your background. Would you be able to share that a little bit with the folks here with us today?
Sure, Boris. I've been working in the financial service space for 36 years. 31 as a banker, my last 17 at Wells Fargo, both as a senior risk leader. Last job I had there was the chief risk officer for Consumer Lending Group. I also ran the home equity business during the last financial crisis. And then more recently, over the last 5 years, I've been working in the fintech space, both as an advisor, board member, and for 3 of those 5 years, I was the chief risk officer for SoFi.
Great. I mean, that's, it's interesting that you talk about your experience and some of the things that you've seen. Ultimately, you've seen the ups and downs of the credit economy take shape, and we're maybe in the beginning stages of one of those cycles. But how's the cycle going to be? Maybe similar, maybe different than the ones that we've encountered in the past.
So I think that's a great place to start. And the way I characterize it is normally recessions happen over a period of quarters. You can start to see it in the credit world, in your delinquency. You can start to see it in the way people use their products. And so what's different about this one is that this was precipitated by a health crisis. Mm-hmm. And so really a deep drop in the economy has occurred in really just a couple of months. Right now, with the latest unemployment claims, most economists, officially we were at 14.7 in April of unemployment rate. We're probably around 20 to maybe a little over 20% right now. And so the speed by which that unemployment has occurred, 36 million people filing claims really in the last couple of months, has led to the highest level of unemployment since the Great Depression. I think the other question that's really on people's minds is, while it happened so quickly, which caught us all by surprise, how quickly will we recover? And right now, I think the country's in the phase where most of the states are starting to open up, most very cautiously, I'd say. And obviously, we have the risk of further infection, when this happens. And so most economists, I think, are expecting to have a longer tail recovery than I think people had initially hoped for. And so my personal view is that the next 18 to 24 months, we're going to be recovering to get back to really where we were before this crisis was precipitated.
Yeah, well, it's interesting, and we're based on what you're telling there in the timeline that you're really painting, it sounds like from at least a consumer credit perspective, we could be just in the beginning of this. And so as organizational leaders think a little bit about that and being at the beginning of this crisis today, what should they be doing to prepare better for it as this thing sort of winds and goes forward, if you will?
Yeah, I think it's a great question. And I think the way most organizations have started to deal with this is that we've seen deferment and forbearance used across really all the products. And so, what that does is it buys each organization a little bit of time to really further evaluate and build the infrastructure, the staffing, the training, the treatments that they really need to address longer term hardships. If you kind of reflect on the point I made earlier about a much longer recovery, I think, than people initially hoped for, what it really highlights is the need for longer term treatments. And frankly, deferments and forbearance, while in the mortgage space, Fannie and Freddie and FHA, VA have allowed treatments up to 12 months. It's in 6 months, and then you can request it again. Most of the other products are really deferring for maybe 2 or 3 months. And outside of the real estate space, there aren't as well developed tools from the last crisis, which was precipitated by the real estate drop in real estate prices. The real estate businesses built loan modifications. They have a waterfall that allows them to extend term and lower rates and forgive or forbear balances that creates an affordability for the customer in the case where income is less than they were earning. And while we talk about unemployment, there's also people who have had their hours cut. When you think about a household, particularly around real estate, it might be in many cases where 2 people are working and maybe one of them has lost their job, or maybe both of them have had their hours cut. And so you really have to design the treatment for the particular circumstance. So what people need to be thinking about at the company levels is first off, establishing what some people have referred to as a control tower. It's really a place where information and people who come together. You need your marketing teams focused on strong communications to customers. You need your risk and compliance, legal, collections, and operations people working together to figure out like what kinds of treatments you can build to address the various scenarios of what the off-ramping needs to be for those customers. And then while you may work within product or similar product constructs like unsecured, home equity and mortgage probably work together, et cetera, all that needs to come together to make sure that you have a consistent customer treatment. What's important is to think about it from the customer back, and many retail banks have multiple relationships with customers. So it's important that as you think about how a product might treat somebody, that they're not getting one treatment that makes them feel valuable and recognized in one product and not recognized in another. So it's really important that it come together and think about the customer relationship in total. So, the biggest thing that I think we lack right now is the resources. We don't have all the treatments, and we don't have all the technology and people. So really, people have to be working on the plans and the priorities to address these longer term challenges that we have. In a lot of cases, people will be tightening up the credit box. People will not be looking for credit as much as they normally might, and credit inquiries overall are down quite a bit since this pandemic began. So you should be moving resources from underwriting into loss mitigation, because basically loss mitigation is really just a re-underwriting of the customer on the back end part of the business. You should be moving some of your best leaders into the areas where you need them the most, because right now it's a very challenging experience for people who are working at banks. Number one, many of them are working at home. Many of them have family or friends who have been impacted, and they may their families may be impacted. So leadership and strong communication and employee assistance and support are the things that companies need to provide to their teams. There's a phrase that I used to always hear that stuck with me for many years is, if you take care of your team members, then they'll take care of the customers.
Right.
And so it's really important for companies to make their teams feel valuable and cared about right now.
Yeah, absolutely. I couldn't agree more. And I think what struck me is the example that you gave around, if you will, treatment paths that have existed for quite a bit of time in the mortgage space, or in the mortgage or the secured industry, if you will. What's interesting is, I think a little bit about the variety of financial institutions that have sort of really were born, if you will, over the course of the last few years, specifically whether it's fintech companies or folks going directly to consumer, whether it's in the secured or the personal lending space versus banks and credit unions. So I'd love to get your take, Kevin, it seems like they would all weather the storm, or this storm, a little bit differently. What's your take on who is well positioned, or who is better positioned, maybe is a better word, for this?
So, the fintech world grew up in a post last recession, low interest rate environment.
Yeah.
And the one keen advantage that banks have over fintechs is a thing called deposits.
Mm.
And so deposits, it's interesting when markets get volatile and the economy turns down, people put more money in banks.
Yeah.
Because they know it's insured. They're not sure what's going to happen in the stock market. So banks are flush with deposits. Fintechs typically rely on, three sources of funding. They may rely on capital markets through securitization. They might rely on investors or insurance companies, and they typically would have wholesale lines, bank warehouse lines that help fund for things that they might have to hold before they sell through those other channels.
Right.
And so right now, credit spreads have widened a lot for many products, and securitization markets are not available. The investors have become quite skittish and not really sure what the loss curves really should look like. And as portfolios deteriorate, and they haven't yet, because forbearances and deferments have basically held down delinquency pretty well.
Right.
But people will worry about the triggers being hit in their bank warehouse facilities, which could force amortization, and people have to rely on cash or equity on hand, and most of the fintechs don't have tremendous cash reserves. So this is a real advantage right now for banking environments, and some of the fintech companies have stopped originating,
right,
dramatically cut originations. And to reflect on the things you should be doing right now, like all institutions need to tighten their credit box. Models are much less reliable than they were. They are built on historical data in a very different environment, and the relationships between different characteristics that are in the model may change in this go-forward environment. But there's a number of tools out there between deposit aggregation, the work number, TrueWorks, a number of different places people are using to try to step up their focus on that. And really, in dealing with the existing customers, it's really about the toolbox and the resources, and all digital here. I think that the face-to-face interaction has a health risk associated with it now. So I think being able to reach out and communicate on an omni-channel basis, whether it be over the phone, through chat, through SMS, through email, and basically be able to, to understand as customers move between those channels exactly where they are and where they're at. That's critical to really understanding and I think scaling the response that you're going to need to have in this type of environment.
Yeah, yeah. And I know you and I talked about that, it's a bit of a shift. And one of the things we specifically even discussed was this notion of how well some of the fintechs performed, not from maybe a credit perspective, but more for some of the capabilities that they have built themselves, and being able to attract the consumer with these sort of channels that they adopted perhaps a little bit quicker than the traditional banks. But I also want to turn the conversation a little bit, Kevin, because we're talking about the full credit life cycle, and we've talked a little bit about forbearance and recovery. What's interesting is that, to your point, how much we've relied on models to predict future behavior. And as folks now transition to this notion of needing credit, or new folks needing credit now in this particular time, where they maybe they've had their hours reduced, the question will be, how do financial institutions handle this if they haven't had a model or a good predictor for this behavior before? In other words, how will we underwrite risk today?
Yeah, I mean, every institution by now has made significant tightenings in credit.
Yeah.
If you're in the secured credit area, you're lending less as a percentage of the collateral value, whether it's in auto or real estate. Some of the research I've seen, at least in the unsecured space, is that the low risk people with the highest scores on a relative basis might actually be a lot worse than the people who are high risk.
Right.
So it might actually, they still may be on an actual basis way less risky, but on a relative basis, you might see their loss risk triple, and maybe the people who are on the non-prime area, maybe it'll be 1.5 or 2 times as bad. And so it's really hard to know. What you've got to do is create the right management information and tracking. And then what you've got to do is see how your model development data emerged month by month, maybe at a 30-day bad rate, for example, and see what you're seeing by score as your newer vintages are emerging. And then you use that to have a very dynamic process to feed back into maybe cutoff adjustments or credit overlays that you need to add in on top of it. So in this environment, you've got to create the process, and that's why a control tower kind of at the company that feeds up through the product levels so important. You're going to have to iterate and make changes on a much more frequent basis than you would normally have to do in a more stable economic environment. As you learn things,
Right.
as you study the data, as you segment the populations, as you get feedback from customers, that's going to be important to be able to feed back to the people in those teams who are able to then take it into strategy development and actual actions that you need to take. So that's easier, in my opinion, on the front end.
Yeah.
On the back end side of the business, it's going to require technology. If you haven't digitized and you're going to be using overnight mail to send documents back and forth, if you're going to be using phone for most of the conversations, the biggest concern I would have would be the volume of customers that need to be served.
Right.
And you have a big staffing, training, coaching challenge. The digital channels give you the ability to be more efficient, shrink the cycle times, and they allow you to scale up more easily with a little less resource.
Right.
And so I would encourage people, particularly in the mortgage and real estate space, to at least be able to build some capabilities to pass secure documents back and forth, to be able to use like a DocuSign to sign a modification agreement or a deed in lieu agreement or whatever the treatment has to be to help that customer in a respectful and responsible way.
Yeah. It's interesting that you say that. I mean, I clearly picking up sort of that statement from that control tower that you've made around really tying in operations and marketing and risk all in the same room and making sure that they speak with each other. I also love your comment regarding the utilization of digital channels. I mean, the question that we always have for a lot of folks is, and a question that I'll pose to you as well, digital channels aren't necessarily new. I mean, they're somewhat new, but what do you think has really specifically has, I'll call it, not made people, especially in the financial services industry, run to those channels as quickly as maybe others or other industries have?
Well, I think if you think about fintech,
Yep.
most of these fintechs started with a blank sheet of paper.
Right.
They weren't hampered by legacy systems. They weren't hampered by physical distribution and multiple channels that they had to plug into, where they had their own, sales platforms, whether it be a phone bank or a branch system or, a telecenter or whatever it happens to be. And so it's a little easier for some of the companies that have grown up over the last 10 years or so to be able to build out the digital channel, because that is the channel.
Correct.
Right?
Yeah.
I mean, yeah, they have phone banks, they have customer service, they do direct mail, they sell through the mail, but principally digital channel, digital statements, digital apps or web are the ways that people interact. And so when it's your most important channel, people focus on optimizing and making it as easy as possible to self-serve through that channel.
Right.
So, I think the banks, have a tougher problem to solve because they're trying to plug into the digital channels and not necessarily scrap all the old legacy systems.
Right.
And it's a harder problem. It's not an impossible problem to solve, but I think it's a harder problem to control the customer experience and to make it omni-channel when you're hampered by the technology that's in place that basically serves as either your accounting system or your servicing system in this case.
Right.
So I think that's why what I'd like to see is just some basic capabilities that allow the experience to be better, to allow for the cycle time to be shorter, and really allow the financial institutions to scale a little bit better, because that reduces the challenge that they have around training, staffing, moving resources around, hiring resource in an environment where people are working at home or largely at home. It's going to be a very challenging environment to try to train new people when they're not really working next to their supervisors.
Right.
So I think it's an unprecedented challenge right now, which is why the industry, I think, has gone to the deferment forbearance route because of all the challenges that we have right now. So my view is that what banks need to do is they're going to need to get to the cloud eventually. They're going to need to rebuild some of the technology infrastructure, and some people have already done this or are in the act of doing it. And they're going to need to go digital beside just mobile. Mobile is an endpoint, in my view, but having everything along the way be digitized is also an important component of it. And so I think banks, a lot of them have got to realize And I think as we get through more innings of this crisis, I think it'll become apparently clear to everybody, abundantly clear, that digital is the way to go.
Yeah.
Like, and for those that are in risk, this is a time where you're going to have more budget, you're going to have more mind share.
Yeah.
Those in operations, the people who are really the front line dealing with customers. So this is the time for you all to ask for what you really need.
Yeah.
Serve the customer that you have the right way.